So welcome back to the series where we are demystifying on how these super traders manage to make three-digit returns and how they're able to pick winning stocks again and again and again. So we've already established that most of them are using the CANSLIM strategy from William O'Neill's book called How to Make Money in Stocks. And in this series, we've already covered CANSL. And in this video, we are going to cover the I, which stands for institutional sponsorship. Now let's make this straight. Big stock moves don't happen because of small investors like me and you. They happen because of big money. Mutual funds, pension funds, hedge funds, insurance companies, big powerful institutions, domestic or foreign, that control most of the market's daily volume. If they're buying, prices rise. If they are selling, prices fall. That's why understanding institutional sponsorship is absolutely critical. Now, why institutional sponsorship? Institutional sponsorship simply means on how many institutions own a stock and who are they. It's never about the analyst opinion or the YouTube hype. Those don't move the markets. Institutions do. Now, a great stock doesn't need hundreds of funds piling in, but it should at least have few serious, high-quality sponsors. See, if no institutions are interested, that's a red flag because there's no demand to lift the price over time. The next thing is look for quality and growth in sponsorship. It's not just how many institutions own the stock, it's who owns it and whether that number is rising. Two key questions you always want to ask. Is the number of institution owners increasing each quarter? Are top performing funds buying it? Now, the book gives an example. Funds with an A or A plus rating, top 5% performers, backing a stock are a big positive signal. When smart, consistent funds start new positions, it means they see potential and they usually keep buying more over time. That steady demand can quietly push a stock higher for months. Even though institutional filings come with a delay, they're still useful. They tell you which funds are moving in and who's quietly moving out. So buy companies with growing sponsorship. The best stocks usually check two boxes: strong earnings and sales growth, rising institution ownership quarter after quarter. When both line up, you're seeing a classic early stage leader. It's a phase where funds are still building positions and prices tend to trend up smoothly as the demand builds. That's why the CANSLIM strategy focuses on growth in sponsorship. It confirms that real money is behind the move. Now, beware of overwhelmed stocks. So here's the other side of the coin. Too much sponsorship can also be dangerous. So if every major fund owns the stock, there's nobody left to buy more. And if bad news hits, all those funds try to sell at once. And that's how crashes happen. So the lesson out here is when a stock is over-owned, the big upside is usually already gone and the risk is just beginning. See, even the untouchables fall. So why institutional sponsorships matters for you? Institutional sponsorship gives your stock liquidity. It means there's a consistent buying and selling which is happening every day. With sponsorship, you can easily enter or exit trades. Without it, you might get stuck, especially in corrections when nobody's buying. That's the difference between stock and real estate. Stocks are liquid because institutions are always active. That's what keeps the market always moving. So the smart rule out here is look for balanced sponsorship. You want enough institution ownership to show confidence, but not so much that the stock's already crowded. A few dozen to a few hundred quality funds is healthy. Thousands, be cautious. The best setups are often under accumulation, not already maxed out. So here's a quick checklist for institutional sponsorship. The stock should have growing institutional ownership quarter after quarter. High quality funds A or A plus are buying, not just random ones. The number of sponsors is rising and not falling. Avoid over-owned stocks. When everyone's in, the upside's gone. Remember, institutions create demand, but even their favorites can fail. The bottom line is big money drives the market, not the opinions, not the headlines. Your goal isn't to fight the institutions. It's to follow them early while they're still accumulating shares quietly. That's when you get the most smoothest, most powerful uptrends. But also stay sharp. Once a stock becomes overcrowded, it's often time to move on. Because in the end, institutional sponsorship is your confirmation that real money is backing your stock. But over ownership is your signal to start planning your exit.